Hey everyone, this is Ben. I do the All in the Reflexes Substack, and you can also find me. Any of the videos that I do there we'll post on YouTube, and then I also post on X throughout the week, different charts and ideas, memes, things like that. So tonight, this is video number 2, and I want to go through the market timing signals. We've got a little bit of change to them that we'll walk through, and I've got a couple of different breadth measures that I think are interesting to take a closer look at as well. So I've got the 10 market timing signals that I track, and they are ordered from more responsive down to least responsive, and so these last 3 are more of like a lagging conformational type of indicator. By the time that these things are starting to fire, I'm in pretty much a fairly risk-off mode, and then starting to plan for re-entry, right? And these earlier ones can be a bit noisier, and if I react too quickly to them or too extremely, it puts me at risk of being whipsawed and chopped around in the market. So that's why I order them from fastest to most sensitive to least sensitive, and monitor their trend. I try to update these at least every 2 weeks, and I'm working on some automation to handle it for me. But anyways, we've got the beginning of the month was the most favorable that these signals had looked in a very long time. They looked pretty dire as we got towards the low at the end of March and into early April. That's when I posted videos and a couple of updates on what we would look for a rebound in the market, and I think we navigated that really well. And so now we've got potentially some risk that we're starting to cool off a bit, or have the potential to see a pullback in the market, whether that's healthy or or something more extreme. We'll have to just stay open-minded and flexible to find out. But right now we've got 3 of these indicators moved into a yellow, and so we'll take a look at those as we go through. So let's start with just a look at the S&P in general. So I posted this the other day, and when we take a look at the market, these lines are all the heavier dashed line is separated by $1,000 increments. And then the others are separated by 500 and 250. And the market just kind of stair steps its way up in these increments, and it's rare that we only touch one of these increments one time. We're normally seeing, we move up to a new level, get some resistance, we come back to an old level, and we retest these things, and then we climb our way back up. The market, behaves, consistently a lot of the time. Even this very large drawdown last April came right back, close to, a prior high, but we came right back to 5,000. Right? These are psychological levels that the market is drawn to, and so when we were breaking above 7,000, I remember we were getting close to it, like back at this level, and I said, it's unlikely that this is the only time that we're going to touch 7,000, right? And so we hit 7,000, we come all the way back down to 6,500, and then we're breaking through it, and we're up to 7,500. And look at that, we wicked up to 7,500. We've got a doji. We don't make a decision. I don't, anyways, like to make a decision or predict an outcome on a single candle pattern, but the candle that follows would present us with a 2 to 3 candlestick pattern, and that might tell us, give us more insight. But these are, an initial sign of a potential reversal. The fact that the wick went right up into a level where we would expect the market to, take a little effort to get itself through 7,500, and most likely, it's possible that we could come back down to 7,250, 7,000. These aren't predictions, just scenarios that I can try to anticipate and would know what to, how to work with. If we were to come back down to 7,000 and then work our way back up, that would be really constructive market behavior, right? And if we break through this level and move higher, I would not be surprised to see us come back down and test 7,500. We rarely touch these levels one time. It's typically 2 to 3. So that's psychological levels of the S&P. Um, I've posted a lot on X recently about, and in some of the groups, about the volatility signals that we're getting. If you don't follow Andrew Thrasher, I highly recommend following him. He shares a lot of information for free on his Substack and on X. I subscribe to his work, and his timing signals have helped me tremendously in the market these last few years. So we've got the VIX in the top half, and I've shared this a number of times, but I use the Keltner channel. It's really similar to it's conceptually similar to a Bollinger Band. They don't have that big expansive and contractive bulging and squeezing that you get with Bollinger Bands, and so what I like about this is when the VIX is above its average, and I'm using a 10-period moving average, so this is not the basis line from the Keltner channel. The 10-period moving average is important to me for another reason. So when we break above these Keltner channels, that's usually a pretty exhaustive movement, and then once we're back below it and the Keltner channel rolls over, that's 100% of the time has marked the local low for the S&P. And the VIX and the S&P are inversely correlated. So that's the Keltner channel, and we can see it expanded, and these don't, like we said, these don't expand to the same magnitude that a Bollinger Band will. So when we see expansion, that's meaningful. And now we're tightening, right? And so you get these, the bands tighten like this, and you've got compressed volatility, and so the bands are based on a 20-period moving average, and I've got a 10-period moving average in the middle. So this is, just visually, we're seeing back here at the end of 2025, the 10-period moving average is moving up. You're putting in a series of higher lows in the VIX, and the bands are contracting. So Andrew Thrasher has a paper called the Volatility Tsunami. He's using a standard deviation of the VIX and a standard deviation of the VVIX, and the combination of the two of them tell us when the VIX is overly compressed, and when it's overly compressed, it's at higher probability to have a spike high. Those spike highs, they're not necessarily a huge drawdown in the market. We can get big market reversals without compressed volatility in the VIX, and compressed volatility in the VIX may only mean a spike in the VIX and a relatively muted reaction in the market, and we can look at both of those. But here's the VIX alert itself, and so these red tags are telling us when the VIX has entered that extremely compressed state, and as it has, did I save these? Might not have. So the VIX enters this compressed state, and you've got, usually within 15 sessions of within 15 sessions of the first alert is when you start to when you can start to anticipate a spike high in the VIX. And so you can see back here we got our first signal in July 2025, and then we got another one in September 2025, and we had that spike high in the VIX less than 15 sessions later. And again, this one was almost right at 15 sessions. I've got a couple of cycles that I've taken out of the from measurements that I've done with the Foundation of the Study of Cycles app, and that's why those are overlaid. Now, when we take a look at the VIX, this doesn't look like a massive movement, right? But let's take a look. You've got, so from the low to the high, this is a 36% movement in the VIX. And then from the low to the high, this is a 55% movement. Compare that to what we saw in the S&P, and you've got, this was like a, I'll get rid of that one. Anyway, these are off center a little bit. So even though these are off center, here was the high that lining up with the low of the VIX after we got these signals was the high of the S&P, and the S&P drew down 3%. And then similarly back here where we had the 36% spike in the VIX, the S&P drew down 2.4%. So we said, these things don't always precede a major move down in the market. In this case, we were really, really compressed, for the middle part of 2024, and then we got this massive VIX spike and a big drawdown. So, they can precede large drawdowns, but it's not, it's certainly not a requirement. And so we've got that signal now, and it fired for the first time on May 8th. 15 sessions from May 8th would put us at the very beginning of June. That happens to line up with a cycle reset, and it doesn't necessarily mean that we'll get a high or a low on that day. It's just, we've got two fairly consistent cycles that we can see the VIX operating within, and so I've got both of those included here. Would not be unusual to see, a higher high in a like an equity or something in the final 2/3 of the way through its dominant cycle. The VIX doesn't always behave like a regular equity, though. So focusing back in on just the VIX, I've got a couple of other things on here. I'll hide the drawings again. So I've got some blue tags. This is another method that Thrasher uses, and so the indicator that I just turned on is looking. It's measuring the distance between the VIX and its 10-period moving average. And once you get about 5 points away from the 10-period moving average, it's fairly exhaustive, and you tend to be close to the end of the move for the VIX. And that's true even you get back into here in 2022 where we had that big drawdown. Once you start to get 10 points above the 5 points above the 10-period moving average, that was pretty close to a local high for the VIX. So once you see these, you're probably pretty close to like a market low and a mean reversion, back to a moving average. So focusing back in on current day, we had those couple of moments in March and then again in April where we were, these are both in March, where we're 5 points above, more than 5 points away from the moving average, turning the drawings back on. Right after that happens, the Keltner channel, it returns to the Keltner channel, and the upper band rolls over, and that was our local low in the S&P each time. So these are tools that you can use. The distance from the moving average and the VIX alert are my own, but that I've coded. But you can use a Keltner channel with just this upper band on the VIX, and that rolls over. You monitor a 10-period moving average with it, and that's really all you need to be able to use the VIX to anticipate having seen a local low in the S&P when we have a volatility event. So that's a lot on the VIX. I won't spend as much time on some of the other charts, but I tend to find this pretty interesting, and it's been one of the more helpful tools for me. In the previous video, I talked a little bit about credit spreads. This looks at the yellow is the spread between investment grade and junk bond yields, and the wider that gets, when it's wide and it's growing or rising, that's a headwind for equities. They rarely rise together, and that's why I'm using a correlation coefficient in the middle here, this teal line. So, once you start to see this teal line rising towards the neutral level, that tells us that we're, one of the two have to pick a direction. They don't move in the same direction for very long. Right now, the credit spread is flattening a little bit. So it was falling. They were moving in this inverse relationship, but right now the credit spread is flattened a little bit, and the rate of change is rising. And so that's it's not alarming yet, but it's cautionary for equities. Getting into the timing signals, this is the volatility weighted put call ratio. I've got the leading version of it and the lagging version of it. The only thing we can take away from this right now is they're both bullish. So this is taking a measure of the put call ratio and 3 other measures of volatility and seeing if there's an imbalance between them. Right now there's not, and we're above our trend lines. So that one's favorable. Unfavorable, we've got the shorter term rolling new highs minus new lows has flattened and then fallen below its moving average. So that's bearish. NYSE volume is falling. That tells us that the trend in this, breadth movement is not terribly strong. So it's kind of a weak signal. And the 50 period, the cumulative new highs minus new lows, relative to its 50 period moving average, it's still positive. It's flattened and it's narrow, but it's not awful. So it bears monitoring, and we'll keep an eye on it. But I gave this one a yellow, but it's a fairly weak signal. There are other breadth measures that I find more alarming right now. And that takes us to the bloodbath indicator. So this middle one is the selling climax. This is from Larry William and Ralph Vince's paper from the Dow Award a couple of years ago, where the 4% or greater, if 4% of equities are making a new low intraday, that's a high risk day to participate in the market. And we had a couple of those this week. Friday got real close. I think it was just under. And then Wednesday it triggered a 4%. Below, I've got a composite of risk factors that I keep an eye on. Things like the VIX, the credit spreads, those types of instruments, right? But it's and I score them based on whether they're positive or negative and which direction they're moving in. And so red is bad, green is good. And right now, it's trending towards a bearish movement, but it's still in positive territory. So I gave this one a yellow based on the selling climax signals that we got earlier in the week. And then the second indicator from Larry Williams and Ralph Vince's paper is this extreme vulnerability. And so if we go too many consecutive sessions without an extreme low, like less than 0.5% of companies making a new low, then that tells us that we're at risk of a shift in optimism. And just about every time that it's climbed up above if this goes on for like 3 trading months, 65 sessions, then we're at risk of a larger drawdown. And then afterwards, you tend to see it reset a lot. So it's reset, multiple times since the April drawdown, and it's starting to climb right now, but still in very bullish territory. The middle indicator is the advanced decline line divided by its 32-week moving average, and it's got a Bollinger Band applied to it. Usually when we start breaking below the Bollinger Band, we've got some warning signs, and you see the market pull back a little bit. We've broken below the Bollinger Band twice this week, so you've got the advanced decline divided by its moving average is declining and falling below a tightened Bollinger Band. And price has not fallen with it yet. So this is what we're hearing a lot of people say about breadth right now, is that the market is moving higher but without participation, and I'm seeing that as well. Now the thing with breadth is that it matters, but it doesn't tell you when it matters, and it can resolve. So you get a case like this where we're breaking below we're breaking below the Bollinger Band, and then all of a sudden you get expansion, and now breadth has corrected itself. Again, with the selling climax back in the fall last year, was climbing. We were breaking below the Bollinger Band, and then it resets, and you start to get like a basing pattern in it. So it can resolve, but until it does, it tells us that we need to that caution is warranted. So that one's a yellow. And then the last yellow, this one has stayed yellow because it just has not resolved yet. But we've got the percentage of S&P companies that are underneath their 200-day moving average on the top, and that is currently in bearish territory because it's more than 45% of companies are below their 200-day moving average. The S&P is still above its 200-day moving average, so you don't have a combined risk signal. And then on the bottom we have two measures of average true range relative to the 21-day, 21-period moving average for the S&P. The first is on the daily, and the second one is on the weekly. And the weekly is slower, but gives good confirmation. The daily is noisier and choppy. So the daily recovered back in late April. We've kind of struggled to stay a good distance below struggled to keep more than half of the market above its 200-day moving average. So that's remained a yellow for us. And the weekly has, rolled over positively, right? It's like it peaked at the end of April and it's been turning downward, but it hasn't crossed below its moving average yet. So it's not cleared. But these are things that can resolve without the market falling further. We need to see that broadening participation to be convinced. This comes from this is the 5% drawdown signal. And this comes from Andrew Thrasher's paper, the 5% Canary paper that he got the Dow Award for, I think maybe 3 years ago. So we made new all-time highs on the 14th of the month in the S&P and the NASDAQ, and people are very bearish. You have some bearish sentiment right now, and that's not unusual to see people get bearish at all-time highs, and that type of pessimism is generally fuel for continuation. I want to see the breadth aspects improve, but my bias would be towards if we see a drawdown that it's not a deep correction, just a healthy pullback. But as long as we stay above, we don't draw down, greater than 5%, which would be about 7,100 for 7,125 for the S&P, and 28,100 for the NASDAQ. That's the 5% level, and this monitoring window is open for us until the 5th of June. And remember, we said, back here on the VIX, 15 sessions from the first alert of a compressed VIX is, June 1st. And so we've got this, drawdown monitoring window. And all this tells us is like if we're below 5% before before the 5th of June, that's an alert, and then that requires confirmation, and confirmation comes when we fall below the 200 period moving average for 2 consecutive sessions. So it's there's a lot that has to happen for us to get there, and I'm not saying that I think that we will, but this is the monitoring window. But generally, new highs are bullish, and new highs tend to be statistically more likely to be followed by new highs than new lows. So, what happens within 15 sessions? Again, it's timing and it's magnitude that are important to us. We'll point out the Dow has not made a new all-time high since the fall. This is the multi-time frame momentum indicator template that I use, and so you've got the monthly S&P. Obviously these all look very bullish, right? We're in bullish territory on the RSI in every time zone. The ADX has the positive directional index above the negative directional index, and ADX is rising, but not at an unsustainable level. So this is this is generally bullish. I mean, we're bullish in every time frame here. Hard to be bearish when you're making new highs, but again, the breadth piece concerns me a little bit. 2 more to look at. We've got this is the equity commodity model that Martin Pring uses. We had an alert back here in early March. This is a monthly chart, so it's very slow, right? But you've got this is what's interesting. You've got commodities and equities moving up at the same time. Commodities are moving up much more steeply, which is not, generally you don't see commodities making a steep movement with equities continuing to drift higher. Once commodities start to make too steep of a movement and separate themselves from the rate of change in commodities, that's when you can see equities pull back a little bit. Or I'm sorry, commodities outpacing equities. So in the middle, you've got commodity momentum, and that's been rising, and it's taken a steep shift higher. And then you've got the stock commodity stability measure below, and this is looking at the rate of change for equities in black, the rate of change for commodities in red, and the difference between them is a histogram. Now, when the difference between them is positive and you get the gray bars above the 20 level, that's one signal of risk. So there's 3 things that would make us three things that would be required for us to have a red alert on this chart, and any one of them I would mark it a yellow. But if both rates of change were negative, that would be bullish. You don't want to see commodities and equities going down at the same time. If the rate of change, the spread between the two rates of change exceeded its threshold, that would be a signal. And if inflation-adjusted stocks fall below their moving average, that would be the third signal. And so we don't have any of those going on right now. And in fact, we've not had more than two of those things since the COVID low, or COVID drawdown. Is that true? No, yeah, we had them in 22. Last chart, this is the Fisher and Kopic model. It's got a very high win rate, and it's not a huge sample size, even though this is the S&P. But this is a 2-week chart, and so this is lagging confirmation for me. I'm looking for these moving averages. One is a moving average of the Fisher itself, and the other is a least squares moving average, and so when the averages roll over and fall below zero, that gives us a signal. So these averages are crossing, and that actually, I'm going to give this till the next session close to make a determination, but that actually could trigger yellow for me. This is a very slow moving indicator, so sometimes an alert will come in after other alerts have cleared. The Kopic curve rolled over beginning at the end of 2025, and but it's since stabilized. It found a local low at the end of March, and took one leg up. So we have to keep an eye on this, but but it looks like these have remained stable and steady. So no concerns on the Kopic curve right now. So that takes us to breadth, and we'll take a look at a couple of different measures of breadth. So we've got so in this screen, I've got some breadth and some risk measures that we'll go through. These are the tables that I post once in a while. The most current session is on the left, and on the top chart it's daily. So this is 20 sessions worth of data, and on the bottom it's weekly. So it's 20 weeks worth of data. So you've got 4 months versus the most recent month. And so this is all of our sectors relative to the S&P, so a relative strength to the S&P. And we can see that for the last week, the only things that have been favorable have been tech and semis. And so hopefully, if you're trading or investing, you've had exposure to that and you've done well. If you're, what I would say is if I felt like I was killing it on semis and on tech, and I've taken some profit. Anytime you feel too exuberant about it, I like to take a little off the table. The last 2 weeks, so essentially what we're seeing here, the past week, only tech and semis have done well relative to the S&P. The S&P has continued to drift higher, and it's been the case for primarily the last month. Those have been the drivers. All of this stuff in the middle, you're not really seeing anything come out of these other sectors. So this ties back into breadth, right? Is you've got only a couple of sectors performing well. Energy picked up a little bit in the most recent session, and the others are having a tough time. The major indexes, their constituents relative to each of their moving averages. So you've got the 20 period, 50 period, 100 period, and 200 period moving average, and I'm showing this for the S&P, the NASDAQ 100, and the Russell 2000. And so Friday's close was some of the worst that we've seen in terms of the number of constituents in each of these indexes relative to their major moving averages. The only one that's really looking favorable is the last week and a half. You've got the NASDAQ 200 reclaiming more than 55% of the NASDAQ 100 claiming its 200-day moving average. When you look at the weekly, we closed the week at we've got 2 weeks in a row of slight deterioration in these measures. The worst time frame, obviously, this is this is the very beginning of March, and this this led us into the drawdown in April, and so this has a little bit of the look that we had back here in This would have been about like March 9th, the week of March 9th, I think, is 10 weeks back. And it has I'm not saying that we're headed into that, but this is the first weekly close that's had the same complexion of that one, since the rebound. So obviously you want to see more green on the left-hand side of the chart than the right. Next, this is the breadth table. There are, you can go onto Amazon and buy a book on breadth, and it's, I think it's at least 100 pages long. I've got a couple of CMT texts that have a lot of breadth formulas in them. And the reason that we do so much to measure breadth is because it's very noisy, choppy data. And so if we look at it on a chart, it's all over the place. So we use a lot of momentum indicators and a lot of smoothing, combine it with volume. You can get pretty intricate with it, and all of it has its place. But at the very beginning of the discussion of breadth, we want to talk about whether stocks are going up or whether stocks are going down. It's that simple, right? And so any of the momentum-based indicators, you can see things like we saw a couple of weeks ago, or about it was 7-8 weeks ago, when breadth was improving. People are saying like, well, hey, the oscillators and the indicators, in the advanced decline line, these things haven't rebounded yet. We don't have we don't have this, we don't have that. All of that stuff is going to lag the actual raw numbers of companies that are advancing versus declining. You're not going to have improving breadth without the number of advancing stocks outpacing the number of declining stocks, and you can just see that with these raw counts first. You've got them divided by one another as your advanced decline line, the number of stocks above the volume weighted average price, the number of stocks making new highs versus those making new lows. And so anytime it's a negative figure, it's inverted just for the sake of the coloration. But the thing that we take away from this is you've got an entire week where breadth got worse gradually day over day. You had a little bit of a rebound in it on Thursday, and then the worst breadth metrics that we've seen in a month showed up on Friday. So this is not what we want to see in a healthy market. We want to see this number going up, not making new lows for a month. And now the closeout for the week was the worst breadth that we've seen in about 2 months. So this we have to go all the way back to that April drawdown to see worse breadth measures across the board. So you've got 1 month lows, companies making 3 month lows, 6 month lows, new 52-week highs. Companies making a new 52-week high were the lowest. The lowest since 17 weeks prior to close out last week. So this is not what we want to see. And we won't dwell on it until we get to some of the other breadth charts. But so that's why we're rightfully seeing some noise on breadth right now. The next chart, this is what I would call the risk appetite chart. So we're looking at a number of things that, like, if participants in the market are bullish, they're operating in the numerator, and if they're bearish, they're operating in the denominator. And so these are all a ratio of one thing to the other. So you got commodities versus treasuries, investment grade bonds versus treasuries, and high yield bonds versus shorter term treasuries. Those are actually fairly bullish, some of the most bullish that they've been in the past month, and even over like the past 4 months. But then when you get into like global equities versus the S&P, emerging markets, small caps, discretionary, home builders are really getting killed. In fact, if you were to keep a chart handy and just keep an eye on it, I would guess that maybe anywhere from like 3 to 6 months from now, we'll probably see a really good sweet spot to pick up a home builders at a bargain. But right now, these are in a pretty strong downtrend. Transports versus utilities, gold versus the VIX, silver versus gold, and copper versus gold is picking up. This goes back to industrials, doing well, but the precious metals are not doing quite as well. And so, each of these are a reflection of risk appetite, and risk appetite has deteriorated over the last few sessions. Not awful for the week, but definitely the worst week that we've seen in the past month. One more of these tables. This one I would call this equity headwinds. So these are all things that are conditions in the market that would imply imply that equities would be more likely to find resistance than support, and these will move later. So you see these. I presented them in an order. Breadth will move first in a trend. You'll start to see the amount of participation in a trend increasing or decreasing. Then you'll see the behavior of the participants in the market shift, and they'll tell you whether they favor risk or whether they favor safety. And lastly, you've got a number of measures that that reflect liquidity and volatility broadly across the market, and credit tightness. So the 3-month implied correlation with volatility, the VIX versus its 9-day VIX, skew, which is really not used as much as a hedging with zero DTA opportunity, just other opportunities for large traders to hedge, but it's still a relative measure, a reflective measure. High yield rate spreads, the move indexes like the VIX for bonds, USDT stablecoins. So these things are still favoring. Okay, most of them are trending well. The Dixies picked up. The rate spread is worsening a little bit, and the rates for the 10-year and the spread between 3-month and the U.S. 10-year have worsened, and those have their worst look over the last 3 sessions and even 3 weeks. So that's the headwinds report. Now, I also look at them as like a composite measure, and this is what I'm talking about with you see the movement in breadth starts to pull back. So generally, you would see these things pull back in an order, right? Breadth is starting to weaken. We have to really use the moving average to tell, because it's so choppy one day to the next. So breadth pulls back, then you've got risk appetite comes down, and the participants are more risk averse. That goes into your drawdown, and the headwinds to a recovery or to a rebound in equities start to worsen, and then you get your rebound after a low. You've got a bullish divergence between declining price and improving participation in terms of breadth, and so that took place leading into this April drawdown. Then you get the confirmation of the low in the market after you've got the low in your risk appetite, and now the types of equities that funds are flowing into are those that favor risk on sentiment as opposed to risk off sentiment, and then your equity headwinds show the reversal. And so this is at the weekly level on the left, and then at the much noisier daily level on the right. And so what we've got going on right now is that divergence. So we've talked about this bullish divergence back here, where equity breadth was on average improving as price was declining, and now you've got price inclining while your breadth measures are declining, and then that's being followed by risk appetite is made a lower high, and you've got a divergence there and a divergence in equity headwinds. So the three things that I would look at to just say, like, hey, do we have conditions that would support a large move up, or are we looking at conditions that would suggest choppiness and sideways action, maybe even a retrace? I'm leaning towards more, at the very least, some chop. Maybe not a retrace, but it's definitely not favorable. And last but not least, on this chart, we've got the this is the skew index, a relationship between the skew index and the VIX. It goes through some normalization so that they can be charted together, and then I've got 2 applications of a super smoother to help cut through the noise. So this, when we had our bullish crossover back here in April, I'd posted about this and said, this is a relatively new measure that I'm using, it's going to break above its trend line, and you're going to have to see a bullish crossover, and then the distance of it from its moving average has to become positive, right? And so all of those things happen like right at the low. This is a really fantastic signal. And then we come up here and we excuse me. Then we come up here and we gap right over our moving averages, which is always a real bullish sign. So now it's got to do two things for us. I notice that a lot of the time you get a rebound from the low and it looks pretty good, but then the moving averages never really make it up past the midway point in the oscillator. So if it reverses here, this midpoint of the oscillator is where I'm going to be most cautious, and it kept going. So it's gone through it, but now the moving averages are very tight, and it's starting to push below its moving average after making a lower high. And you've also got you're up to it's starting to put in a bearish divergence right there. So we'll look to see how this develops. It's noisy enough that it can recover and it can stay and hover around the high like this, and you can continue the market can continue to trudge higher. But in fact, that's normally what we see. So I'm not I'm not overly concerned with this yet. It's just something that I'm monitoring. And then and I'll share one more just because it's kind of cool. But I did this in Python with some data that I've got a subscription to, and I've got three different breadth measurements that are unique. I haven't seen anybody else work with some of this stuff before, but we'll start with this is a weekly breadth measure. This is one that comes out of a Larry Williams book. This is the top 20 accounts by volume going back to 1990, and it's a weekly close. So it just looks at what were the 20 biggest movers for the week, and then were they up or were they down, and like we said at the very beginning of the breadth discussion, the first thing that we ask ourselves is, are equities going up or are equities going down? So this goes back to 2017, right here. It goes all the way back to 1990, but right here we're looking at 2017 to 2019, and I'm looking at that because we've got a transition from an uptrend to a downtrend. And so you can see we've got this, the S&P comes up, it makes a local high, breaks below its moving averages, and we put in that December 18 low. When we look at the weekly close, the biggest movers in the market, and by the way, this data is historical, so it includes any companies that might have gone out of business. It's got survivorship. It controls for survivorship bias. So that's why we can go all the way back to 1990. And then we've got a 10-period exponential moving average subtracted by its a 40-period moving average, and those are moving averages of the net difference between the number of companies making a high versus a low. And so when we see that we've got this, they're starting to diverge, right? You've got from October 2017 to February 2018, you're starting to lose that moving average and it's breaking below zero, and then you start to get this sideways movement in the market. You recover a little bit, and then you have a decisive break below zero, and then the market takes its fall afterwards. So the most important stocks to the market at the time were on net putting in new lows or closing their weeks negatively as opposed to positively. And so that's just a very specific way to look at a trend in a breadth measure. This is one that, like I said, came out of a Larry Williams book, and I'm just now able to apply it with the data that I have. And then as you get into your recovery, you've got your you've got several weeks in a row where the net is lower. Then all of a sudden you shoot back up above 10, and so the majority of the 20 largest or the 20 stocks with the most volume for the week closed positively, and your momentum of moving averages of the net difference recovers zero, and that confirmed that we were at our low. and then you start climbing out of that December bottom throughout 2019. So that's a historical look, and now contrast that with today, right? So we go from 2014 through present, and we could see when we got it was relatively steady, a little bouncing back and forth, but you're oscillating between 2 and -2, and for the most point you've got weeks where the net number is positive and a couple of negatives that don't cross below 10. And then you get this, this deeper one towards the September period in 2024, normally a tough month for stocks. And then you can see it's like there's this arched movement where you're now seeing, the net negative get a little bit worse, and you've got your decisive break below zero, and that tells us that we're headed to, to a low for the S&P, and that was the April 2025 tariff drawdown. That steep recovery is our confirmation that the market's rebounding. So it's very similar to what we saw from 2017 to 2019. You've got an extreme low and an extreme movement in all 20 of our largest stocks closed negatively for the week on net, and then followed by a rapid rebound in the V-shaped recovery. We saw the same behavior this April, right? You get your decisive move below, and we remain below. And that started in November and remained there. So this was a risk signal that I kind of wish I had this data for ahead of time. But we knew that this was kind of a rocky market heading into February and March, and we were starting to see some of our other signals tell us. But this is a great way for us to have known that the largest stocks in the market were closing the week negatively, despite their intra-week movement. And then that leads us up to this crossover in the moving average and in the drawdown. So that's our first breadth measure. We've got two more. If you ever read Stan Weinstein's book on technical analysis, he covers a concept called stage analysis, and he's got 4 stages. And there's a number of people that do this. Mark Minervini does it. Brian Shannon talks about stage analysis in his books on anchored VWAP and multi-time frame analysis. But in stage analysis, you've got four stages. First is this basing pattern that stocks put in, where they have a flat movement and it's the low, and then you go into a stage 2 uptrend, and that's the part of the trend that we want to participate in. And then they go into a stage 3 topping pattern. So it's very similar to stage 1 in terms of the relationship to the moving averages and the range of movement. The volatility and the volume can be a little bit different, but stage 1s and stage 3s, if you look for them mathematically, they look very similar. And then stage 4 is after you've topped. Now you've got a descending movement, and you're in a downtrend. And so the criteria for your basic criteria for a stage 2 uptrend, you've got a rising 200-day moving average. You've got the 150-day moving average is above the 200 moving average. The 50-day moving average is above the 150 and the 200, and prices above all of them. Those are the things that you would look for in a stage 2. There's more criteria to it, but and then a stage 4, much of the opposite is true. And so what this measure is doing is it's just taking the S&P 500, and it's this includes past constituents that are no longer in the S&P or are no longer in business. So it's comparable across a time series going back to 1990. We're looking at just a raw count of how many companies are in a stage 2 uptrend and how many are in a stage 4 downtrend. I don't even care about the stage 1s and the stage 3s because those are flat and they're not doing anything for us. I want to know how many of those 500 companies are going up, and how many have changed and not just topped, but they're actively going down. And then we've got the net of the two of them. And I'm using 3 moving averages just to make it really easy to clarify the trend. But we've got 2017 through 2019 again, and you can see we've got this real healthy participation, markets moving up. You get this kind of rapid turnover here, and you get into chop and a base. But you've got a lot of companies, in stage 2 uptrends, less and less in stage 4 downtrends. The difference between the two of them is improving, and then the market has its topping pattern here. The moving averages roll over right away, and this tells us you've got a declining trend in your quantity of companies going up versus those going down, and then that does not reverse for us. It flattens out and then it falls further. So this was a great risk-off signal that fired and warned us at the beginning of 2018, and could have kept us out of this drawdown in 2019. We wouldn't have been comfortable getting back in and participating until we saw this. And look at this. You've got the net number of companies in stage 4 downtrends bottoms. This is a pretty significant number. You've got on net 200 companies were the net difference between companies in uptrend versus downtrend was less, negative 200, and you've got 287 that were in a stage 4 drawdown at the very bottom. You hit your low in 2019. The number of companies in the drawdowns makes its low, and you're back off to a bull market. So this is a pretty good this is a pretty good timing indicator for us. So let's take a look at today. And this is where I'm a little more concerned, right? You've got similar thing in 2025. Number of companies in stage 2 uptrends. You've got the majority of the S&P 500 is in an uptrend, and then we get that tariff tantrum where we roll over. The S&P rolls over its moving averages and comes down. The moving average of the net difference of stage 2 uptrend versus stage 4 downtrend remains descending even into this recovery, right? You get your bottoming pattern. It bottoms at a net of 100. So it wasn't as extreme as the 2017 to 2019 example. And now we've got this gradual improvement in the market through throughout the rest of 2025 and into early 2026, and then we get our rollover in 26. But the net number of companies in a stage 2 uptrend has declined. So this is diverged from price, and there aren't as many examples of this happening where you've got this big divergence in the number of companies participating in the uptrend while the price of the index moves higher. So I like to make fun of people that are overly bearish. What else am I going to do with my time, right? But in sometimes their concerns are warranted, and some of what we're seeing on the breadth side right now, I think, is so. This isn't to say that this is risk off right now. This is not a safe place for me to aggressively deploy new capital. I'll still look at very strong opportunities, but they have to be A+ and with lower position size for my risk profile. But right now I'm looking to protect capital as opposed to deploy until I see this reverse and we start to see a lot more participation. Very easy to pick stocks when they're all participating in an uptrend. We have to be much more selective when the field of play is narrowed. So that is the stage analysis. One more, because this one's pretty fun. But so I use these. Let's pull one up real quick. I'm big on point and figure charts, and we'll take a look at. We'll scan for some that are bullish. Let's see if there's not a lot that are. Normally I'd get a lot of. Point and figure, or a lot of names pop up on my point and figure screener when I look for a bullish one. But market's not showing us too many right now. So let's see, that one was SIGI. We'll take a look, and I know I've posted these a number of times, but point and figure charts are nice because they take time out of the equation, and they just look at something moving. Is price moving incrementally higher or incrementally lower? And in this case, each box represents 1% price movement, and once a box is full, you start the next one. And if we have price move down 1%, it'll start a row of zeros or a row of O's. And so these also form chart patterns, and in this case we've got a double top breakout, which is fairly bullish, and it's also accompanied by a strong rising ADX. Now this isn't a recommendation, but this is excuse me, this is a company that's got a double top breakout. Point and figure can be used to forecast as well. You take the the low of a pattern and a count of boxes horizontally and vertically, and you can use those to forecast a potential for a breakout and in conclusion to a bullish move. In this case, it's forecasting 104. I don't find these to be as accurate as some other measures that my normal ways of forecasting, but I do find the patterns to be very helpful. If I see technical indicators that if I see a good technical setup for an equity and it's got a breakout point and figure pattern, those tend to do very well for me. So let's go back to our breadth measure. Where to go? So this is a count of the number of companies that, and this is market wide. So this is using Russell 3000 and above, and it's taking a look at the number of companies that are in that are firing a bullish point and figure breakout versus those that are firing a bearish. And I'm specifically looking at double top, triple top, quadruple top breakouts, catapults, and spread breakouts and ascending breakouts. So there's like multiple types of bullish signal that I'm looking for, and I'm counting, just like the some of the other indicators are doing. I'm counting the number of companies that are firing a bullish signal versus those firing a bearish, and then looking at the net difference between the two. And then I'm using two exponential moving average momentum indicators. We've got the 8 period minus the 34, the 21 minus 100, so we get a more smooth interpretation, because like most breadth, this is very choppy. But I don't know many people that I don't know that I've ever seen anybody use this indicator before, so I'm pretty excited about it. So anyways, we get back to our this is 2000. Maybe we'll look at that 2017 again, and we'll go to 2019. And right, that's the time frame that we used. Yes. Okay, so when we take a look at this, this time period, we had, on average, the net difference between the bullish and bearish firing signals was turning positively. When we get that movement below 1,000, that's a pretty big deal, right? So once you start to see the net difference into like the negative 1,000, and you see this, like, you could consider this to be a bearish divergence, because your negative line is moving down in a descending fashion, while price is moving in an ascending fashion, and then your moving averages roll over and have a decisive break below zero, and that leads us into like all this chop, right? And then you get a little bit of a fake out here where you were doing it again, and you got a little burst of companies with a bullish pattern, and then it rolled over again. And so you want to see, what's important here is, let me zoom in a little bit. You put in a low on your moving averages and on your net difference as the stock market was coming to a low. So the number of companies firing a bearish pattern had peaked, right, before the market bottomed, and it had started to recover. And that makes sense, because these are companies that are firing a bearish breakout for the first time, and it doesn't keep reporting it every day. This is the initial time that it fires the signal, and so you had the most companies reporting a bearish breakdown on their point and figure chart on December 3rd, 2018, and then the market bottoms December 25th, right, 24th, and these signals tend to be good setups for me, because they're they've got higher likelihood to have follow through over the course of like 2 to 4 weeks, and that's exactly what we saw. Basically a 3 to 4 week movement after the bearish signals fired. Now you've got a big spike in bullish signals, and that comes right after the market low and the recovery of the moving average, and now you're off to the races again. And so that's why I'm liking this as an indicator. It's just another way to look at breadth. It's a bit more unique, but we've got how many companies are of the largest, most important, are closing positively versus negatively. How many are in stage 2 uptrends, so they're in steady sustained uptrends versus prolonged downtrends. And now we've got breakouts, and so this would tell us it'd be like the trend reversal signal. So I would expect, in this case, we had the December 4th was the low for the breakdowns. Let's take a look back at the stage 4 and December 4, 2018. We were still declining. The number of stocks in a stage 4 downtrend was still growing. So the stage analysis breadth coincided with the low. The point and figure breadth measure preceded the low. So we've got a leading and a lagging indicator that we can work with. And what is it telling us today? So our leading indicator, using point and figure analysis as a leading indicator, we've got this kind of curved top, right? You had we got the low in March was the largest net difference was March 5th. On our stage analysis, the March 5th, we were still positive, right? We were still declining from a positive figure in March 5th of 2025, and so that preceded the low of the market by 3 weeks, and so now we've got we had the big spike, and that preceded the recovery, and now that's cooled off, and it's cooled off kind of drastically. You've got descending trend in the number of companies firing a bullish signal versus a bearish signal. And you saw when I just pulled up that chart, only one of them. Now the way that it measures for bullish signals on this one, it's looking in more than one way and doing it a bit differently than the stockcharts.com screener does. So I use this in my personal screening, but we had no signals come up on Friday. It says that there were like 65 bullish, but none would have met my trading criteria. And now you've got both of your moving averages below zero as the market is topped. And so I'm going to say if this number, we're at a net negative 547 companies fired a bearish, point and figure chart pattern, and 612 in total did. If this gets down to about 1,000, I'm going to be pretty bearish, and I'll probably start to trim positions and maybe look for some short opportunities. But that's what I'm seeing in breadth, and hopefully, if you've stuck around this far, you've enjoyed it, and you appreciate the taking a unique look at it as well. If anybody has questions, or if there's something that you've seen that you want to see vetted out or see me take a look at, please feel free to hit me up on X or message me through any of the investment groups that I'm in, or through Substack. But thanks for your time tonight, and I'll do a third video probably tomorrow on some different opportunities. Thanks.